Hey everyone, welcome back to another dividend investing video. In today's video, I'm going to walk you through the latest moves I made in my investments for February 2025, both in my YouTube public portfolio, the Dividend Growth Income portfolio, and in my Roth IRA. I've got some exciting buys to share, and I'll explain why these stocks made the cut this month. So let's get into it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Let's start with the Dividend Growth Income portfolio. This is my YouTube public portfolio. It's a taxable account I hold with Fidelity, and it's a little more than 2 years old now. I started it when I started the channel, and I've been buying every month since starting the account. In February of 2025, I made a series of strategic buys to further strengthen this dividend growth focused portfolio. Here's what I picked up. On February 5th, I bought 1.768 shares of Mondelez International for $100. That's ticker MDLZ. So I kicked off the month by adding Mondelez. With inflation still weighing on consumer spending, I like owning companies that sell everyday essentials. Mondelez's pricing power and strong brand portfolio, think Oreos, Ritz, Cadbury, give it an edge in the tough economy. Furthermore, its dividend growth remains solid with a 5-year average dividend growth rate of 10%. And this was good timing. I was buying it in January, but then halfway through February, the price began to climb in the second half of the month. Then I think REITs in February were also at a pretty good place to be adding right now. So on February 10th, I added all 3 of the REIT positions in this account. First, I added to Agri Realty, that's 0.689 shares for $50. This is the triple net lease REIT. It's a monthly payer in the fund. While higher rates have pressured real estate stocks, ADC's strong tenant base and reliable cash flow make it a great long-term play. On February 10th, I also added 1.67 shares of Vici Properties, ticker VICI, for $50. Vici is one of my favorite REITs because it owns casinos and entertainment properties like Caesars and the MGM. Travel and leisure spending have been surprisingly resilient despite higher interest rates, and Vici benefits from long-term leases with built-in rent escalators. This one's a cash flow machine, and I like the dividend growth as well. Then on February 10th, I also bought 0.319 shares of Mid-America Apartment Communities, ticker MAA, for $50. Apartment REITs like MAA have pulled back, and I see this as an opportunity. Rental demand remains strong in the Sun Belt, where MAA has a big presence. With affordability issues keeping many people from buying homes, apartment occupancy rates remain high, making this a solid dividend investment. Now, Mid-America is a new position I added in the month of February because I ended up selling out of Comcast, ticker CMCSA, moving all of those funds into MAA, and this was in addition to that. And I made a video about that transaction. I'll leave it down in the comments if you wish to go a few weeks back and get the details on that. But moving on February 11th, I picked up 0.111 shares of Lockheed Martin, ticker LMT. So I picked up a small amount of Lockheed Martin as it dropped a little bit over the month. Geopolitical tensions, however, remain high. Global defense budgets are rising. And LMT's massive backlog of military contracts makes it a stable dividend payer. Plus, with its share buybacks and dividend growth, I believe it to be a solid long-term hold. It's my favorite defense contractor. Shares are down 12% over the last month, bringing it back into my buy range. Then on February 18th, I added 1.471 shares of NextEra Energy, ticker NEE, for $100. This is the largest renewable energy utility in the US, and I like adding to it when I get a chance. Rising interest rates have pressured utility stocks, but NEE continues expanding its clean energy projects, which should pay off in the long run. I see this as a quality long-term dividend growth play. In fact, this month, they happened to raise their dividends by 10%, and that was also a factor in deciding I wanted to have a little bit more of this one because they're consistently doing those 10% raises. On February 24th, I added 0.215 shares of United Health Group, ticker UNH, for $100. United Health is the best-in-class operator in the healthcare sector. The stock dropped recently due to concerns over not only rising costs, but as well as reports of a new probe by the U.S. Senate Judiciary Committee inquiring into their Medicare billing practices. But it remains a powerhouse of strong earnings and dividend growth, so I'm going to take advantage of the pullback and add some more. Then on February 25th, I added to both of my dividend-focused ETFs in the portfolio. First, I added 0.375 shares of VYM, that's the Vanguard High Dividend Yield ETF. This gives me exposure to a basket of high-quality dividend stocks with solid yields. I'm like adding to this ETF because it helps me diversify while still keeping a focus on the dividend income. Then I also purchased 1.782 shares of SCHD for $50. SCHD is my single favorite dividend ETF. It focuses on high-quality companies with strong cash flow and solid dividend histories by following the Dow Jones U.S. Dividend 100 Index. This is obviously a core holding of mine in this portfolio and others as I add to it regularly. So those were my February 2025 buys for the dividend growth income portfolio. I focused on a mix of individual dividend growth stocks, REITs, and ETFs to keep building a well-rounded income-generating portfolio that, most importantly, I can expect that income to grow at a nice rate. All in all, I invested $600 into this portfolio for the month of February. So now let's go ahead and move on to what I bought in the Roth IRA this month. So the Roth IRA is a huge priority in my investing. No matter what happens, I will max this account out, the full $7,000 limit. Right now, my strategy is to add $600 from January through November, and then I'm going to add $400 in December to hit that max contribution amount. The slow and steady approach lets me stay consistent while also keeping cash available for opportunities throughout the year. Now, one key difference between the Roth and my taxable dividend growth income portfolio is how I handle the dividends. In the DGI portfolio, I use DRIP to automatically reinvest every dividend, but here in the Roth, I take a more selective approach, letting my dividends accumulate and then deploying them into stocks that I feel might be undervalued or aligned with the long-term goals. This is why my purchases are going to exceed the $600 I invested for February. So let's talk about those purchases. So on February 4th, I added one share of PepsiCo, ticker PEP, for $143.43. I also added a share on February 6th for $144.39, and then another share on February 18th for $142.77. That's 3 shares of Pepsi added all together. It's becoming a core holding in the Roth because it offers a great mix of steady dividend growth and defensive stability, and I think it was just at a great position to be picking up shares in February. With inflation still pressuring consumer spending, Pepsi's pricing power and strong brand lined up beyond just the soda, like their snacks like Lay's, Cheetos, Doritos, help keep that revenue flowing. Plus, they've consistently raised dividends for over 50 years, making it a perfect long-term hold in a tax-advantaged account like this. I also added some realty income to the portfolio this month. On February 5th, I added 2 shares for $108.10. And on February 25th, I added 1 share for $55.83. So I added to Realty Income, the monthly dividend company, because I love the predictable income it provides. REITs have struggled with interest rates, uncertainty, but that just means better prices for long-term investors like myself. This is one of my favorite stocks for compounding dividend growth over time. They also raised their dividend for this quarter for like the 109th consecutive quarter. It's insane what they do. Okay, this one is a bit more of a speculative play in the Roth. It's on February 6th. I bought 1 share of iShares Bitcoin Trust, ticker IBT. It's 1 share for $54.90. I want a little bit of exposure to Bitcoin inside a tax-advantaged account, and iBit offers an easy way to gain Bitcoin exposure without dealing with wallets or exchanges. The crypto is volatile, but I think having just a small, tiny position here allows me to participate in the potential upside while keeping the risk contained. So for this year, my strategy is to probably add about 1 share of this every month, just to build that up. It's never going to exceed 1% of my Roth IRA, or you probably even come close to that. Then on February 14th, I added 1 share of Alphabet, ticker GOOGL, for $185.53. Alphabet continues to dominate in digital advertising, AI, and cloud computing. The recent market pullback gave me a chance to add a share at a solid price. It's not a traditional dividend stock, but they do now pay a dividend, and they have a massive free cash flow, and I do think this is going to become a classic dividend growth stock over the coming years. And finally, I added 5 shares of SCHG, the Schwab US Large Cap Growth ETF, for $144.08. This gives me exposure to high-quality growth stocks, big names like Apple, Microsoft, Nvidia. So while the Roth has mainly been focused on dividend payers, I do like having some high-growth exposure in there too. The long-term tax benefits of a Roth make it a great place for ETFs like this that can compound over time. So this month, in the Roth, I focused on high-quality dividend stocks, some growth exposure. The Pepsi, the Realty Income continue to generate the income, and while Alphabet and SCHG, they're adding more of the long-term growth potential. But I'm building this account with the mindset of maximizing the tax-free compounding. And these February buys help me stay on track for my 2025 contribution plan. So I'm more or less keeping my purchases about 33% REITs, 33% dividend growth, and 33% growth focused in the IRA this year. So that's my February. I think it was a solid month overall. Later in the year, I'm going to be shifting more resources into the dividend growth income portfolio. Right now, I've got a couple other financial priorities. I'm building up a healthcare savings account for the first time in HSA, which is like a Roth. It's tax advantaged. I'm really pumped about that. I've also increased my 401k contributions this year. I'm making the most out of that company match. That's free money, right? And on top of that, I'm building more of a cash position this year for flexibility. Now, what have you been buying for this past month? Please let me know down in the comments. I'll be getting to work on a next video where I'm going to be breaking down the rest of the dividend growth income portfolio activity for February. So we'll be talking about dividends paid, how the portfolio has been performing, what stocks are doing well, what stocks are not, what stocks might be looking to buy in March. So do stay tuned for that. In the meantime, please check out this analysis of 3 blue chip dividend stocks that just raised their dividend. YouTube decided not to really share this one with most of you, but I do think it is worth checking out. Thanks again, my friends, and until next time, keep investing.